Good morning. Welcome to Trading Hour. I'm Reema Tendulkar with Mia Soni Shenoy and Pavitra Parekh, and the picture is vastly different from where we began. The SGX Nifty in the morning was suggesting a 100-point gap up opening. We had a gap up opening. The Nifty opened above that 18,300 mark, but from that level, it's seen a fall of close to about 200 points. The mid-caps is selling off rapidly. The mid-cap index is down 1.5% for the week so far. The mid-cap index has slipped 2.7%, underperforming the benchmark indices, which are down close to about 0.8%. So the picture is very, very different from what we had anticipated at the beginning of trade. That said, the Asian markets continue to be up and about. Hang Seng is higher by 2.5%. The Japanese markets up 0.5%. The Taiwanese, the Korean markets have gains on an average of close to about 1%. So the sell-off is very much internal, and it's adding on to the weakness that we had in yesterday's trade. So the Nifty is now at 18,100 thereabout, much lower than the levels that we were talking about. One of the important key levels was 18,130 that analysts were tracking, and markets have breached that. There you can see it's about a 200-point fall that we've seen from the top of the trading session. A quick run through of the sectors which are dragging on the way down. Currently, right now as we speak, it's the metal index, which is down 1.8%. You've got the auto index down 1.3%. So these are some of the pockets where you are seeing weakness. The mid-cap index, the banking index is down close to about 0.5%. Good morning, girls.
Hi, morning. I think we'd spoken about this in the morning chat as well, right? As to how there's so much selling coming in from FIIs. There was large selling yesterday and also almost 9,000 crores of selling in the month of December. That there is this kind of volatility that perhaps the market was anticipating. Of course, we woke up. The last couple of days has been like this, where we're waking up to positive cues and then the market sort of sells off through the course of the day. Another level, the Nifty 50 DMA of 18,143 has also been breached now. So, a lot of levels are getting sliced on the downside. Let's see, there was long unwinding in plenty of stocks, whether it's the Adani Group stocks, the auto stocks have been under pressure. Metals are now coming off as well from the highs of trade. So it's not looking like a great session for the bulls. But, the second half of the trading session, let's see how it progresses. For now, things are looking a bit sticky.
Absolutely. And this thing where Reema was mentioning that our markets are seeing these cuts, even while the rest of Asia is doing quite well. We saw this exact same thing play out yesterday as well, where we saw that sharp over 1% cut at the close, but the rest of Asia was looking quite all right. Today, the sectors that are faring perhaps the worst, you're once again seeing the PSU bank index come up with, some big cuts. Real estate is looking quite weak. Let's pull a few of the, smaller banks up for you so you can see. These are some on your screen. There you have it. Sharp cuts coming through. Of course, this is after a big rally as well, but these stocks have been correcting. A lot of the real estate names are under pressure today, so take a look at Sobha, you have Godrej Properties, Oberoi Realty, pretty much the entire sector under pressure over there. In terms of cues, we are monitoring what's going on with the COVID situation in China, and then what it would mean for any kind of regulations in India, and of course what's going on with Brent prices. We're back at 82.5, so that is something that is important to track for our own markets as well. That's the market action, but let me first run you through everything that we have lined up for you on the show as well. The market is near the day's low. Indices fail to hold on to opening gains. Banks and metals lead the decline, while pharma bucks the trend. We'll discuss the market fundamentals with Pankaj Murarka of Renaissance Investment Managers.
And bond yields are higher in trade today. Reacting to the MPC minutes, we'll tell you why the 6-member panel is deeply divided. Their varied opinions a little later on the show.
And premium Indian basmati rice exports jump as demand improves from key buyers like West Asia. To understand the outlook for 2023, we will be joined by the management of KRBL.
And with the onset of the holiday season, malls have seen an increase in footfalls. To get a check on the on-ground demand, we're joined by Sameep Pathak of Oberoi Realty and Mukesh Kumar of Quest Mall. All this and much more coming up in the next 60 minutes.
But first up, let's talk about the rice exporters. Premium Indian basmati rice exports have jumped as demand has improved from key buyers like Middle East. Export prices have jumped to $1,450 per ton from $1,160 per ton. Ashish Jain, the Chief Financial Officer at KRBL, now joins us on the show now. Ashish, morning. Thanks so much for joining in. Could you give us an indication of the export prices versus, say, 6 months ago, the export volumes that KRBL is seeing versus 6 months ago, and how much does exports contribute to your overall revenue pie?
Sure. So, as you mentioned correctly, the prices have been up. And, this has been a mix of various factors that have been in play. One, as you know, India is the largest exporter of rice. And the Indian rice crop this year is about 4 to 6% less than last year. So that's been one key factor which is driving overall prices. And like you mentioned, the demand has been up. We believe this is driven by concerns of various countries on the food sustainability front. So we see customers stocking up, unlike what we used to see earlier. And then there have been pockets of lower production, especially in basmati, where Pakistan had a flood situation, and therefore there are concerns around the output that that country may produce. So essentially, these two supply-led factors are, coupled with strong demand, are leading to the prices being up. Now, when I look at the country's exports as a whole, and if you look at the 7-month period starting April 22, so there the overall exports are up. If I look at basmati exports, that's about 11% up in the April to October period for the country as a whole. Non-basmati exports are also up by 6% in volume terms. While if you look at it in value terms, the increase is even higher, and largely because of the higher prices that we've seen. From a KRBL point of view, we've seen our first half led by a strong export performance as our key countries such as Saudi have come back in terms of demand as we corrected the issues there. So overall, a strong first half from a export point of view. The other side, which is domestic, also continues to be strong. Now, in terms of the overall share of exports, so last year, the domestic sales accounted for about 55% of our revenue. But if you look at the longer term trend, both domestic and export have an equal contribution to revenue.
Okay, so what does this mean for your numbers? Your export revenues in the first half were about 1,000 crores or so. That was a very strong growth of almost 36%. What can you do in the second half?
Yeah, so we continue to be positive. Difficult to give an exact number, but we're seeing the demand trends holding up, both in volume terms and the prices. While it's again difficult to put a finger on it, but we see the prices holding up as well over at least the next 3 months or so. So we continue to be positive on the export side.
Okay, continue to be positive on the exports. Can you tell us then what exports for the full year could look like?
Sorry, we don't give quantitative guidance, but we are looking at a strong performance in the current year.
Has the demand from Middle East, which has surged and spiked in the last couple of weeks, got to do with the World Cup? And is that something which will reverse then?
No, we don't think so. I think that's a one-off event. Doesn't usually sway the demand for agri commodities. However, Middle East, as you know, is the largest destination for rice exports from here. And we've seen the demand continuing to be strong there on an overall basis. I don't think the World Cup has driven it in any way.
Okay. Can you tell us how, last time you had mentioned that one of your plants was going to commence operation by December. Can you give us an update on that, and what kind of capacity are you looking at, say, a couple of years down the line?
Yeah, so, we had mentioned that there's a plant which we're setting up in Anjar in Gujarat, so that we are expecting for it to go live by April of next year, which is April 2023. So that's on track in terms of the timelines that we had mentioned. Now, that's not a very large capacity. However, the logic of setting up that plant was to, to reduce the logistics cost, because that plant allows us to ship rice from the growing regions directly to a location which is close to the port. So that sort of gives us savings on the logistics front, but not a very large capacity there.
Okay, so what kind of savings are you looking at? And you had also mentioned that there is a land acquisition as well that you're looking at for this new plant. How is that coming along?
Yeah, so, we're setting up 3 plants. The one that I mentioned is one of them. There are other 2. One is in Karnataka, where we are exclusively going to focus on the non-basmati space. So there the land has been acquired and the other formalities are underway right now. The third area that we're looking at is MP, which is again a basmati growing region and a sort of a strategic area. There we are in the process of identifying land, etc. So these 3 locations, which is Gujarat, Karnataka, and MP, are areas that we are looking at right now.
Okay, so for these 3 plants, could you take us through the kind of capex that you're looking at, and also if you can provide any kind of timeline as to when we can see, growth out of these plants?
Sure. Yeah, so overall capex that we have planned for these three locations about 250 crores, all going to be funded through internal accruals. Now, in terms of incremental revenue that these might bring in, it's about in the range of 4 to 500 crores in the initial stages. In terms of timelines, like I mentioned, the first one is Gujarat. We expect to go live by April 2023. The second plant, which is in Karnataka, is going to go live in FY24, while the third one in MP, the timeline expected is FY25.
Okay. So once these three plants come on stream, by how much would your production be ramped up versus today?
Yeah, probably simpler to look at in terms of revenue terms. So
Okay.
we expect that once these three plants go live, we can look at incremental revenue about 4 to 500 crores coming in from these three plants.
And what are domestic prices? Export prices are $1450 per ton. What about domestic?
So, difficult to comment on average prices because we sell various SKUs, but what I can confirm is that prices have been up on the domestic market as well, which is reflective of the overall rice prices globally.
Okay, thanks a lot for joining in and giving us a quick update. That's KRBL saying that the demand is holding up both in terms of volumes and prices. They're expecting a very strong export performance this year, and their plant in Gujarat will go up by April of 2023. Well, moving on, the minutes of the last monetary policy meeting showed deep divisions within the six-member panel. RBI Governor and Deputy Governor remain cautious and warn against a premature pause in policy action. External member Jayant Verma says current policy rate and stance can damage the growth outlook, while Ashima Goel calls for a neutral stance. Lata, in fact, spoke to three external members of the MPC. Here's her report on the minutes and the divide within the committee. Lata, over to you.
Yes, it was a deeply divided MPC committee, but the conclusion can be that the Hawks are outnumbering the Doves at this point in time. Key takeaways from each of them. Governors said that very clearly battle against inflation is not over, and the target is to loosening prematurely is harmful, and the target is to get to 4, not just under 6. Deputy Governor Patra was perhaps the most hawkish, saying that core CPI doesn't look like falling off 6 for some time now. And even headline CPI for the next 12 months looks like lingering between 5 and 6, a distance away from the target of 4. The other RBI member, Rajiv Ranjan, said that core CPI is at 6 in spite of fuel falling. So you can imagine X of fuel, things are bad. But he had struck a dovish note when he said that growth may be the bigger concern in 2023 all over the world and in India. Dr. Bhide, the external member, was also somewhat cautious. He said growth and inflation are presenting a mixed picture. It would be a bad outcome to underperform on both. So let's stick to the mandate and try to get inflation lower to target. That was the crux of what he said. The dovish member was really Jayant Verma, who said that growth is very fragile. The hikes we take now are going to impact growth further later on, and therefore will damage growth at a time when the global economy is also slowing down. Voted against the hike and also said that the inflation forecast of 5.4 is suspect because it's based on a crude of $100. Crude is not $100, not in spot, not in futures, he pointed out. Ashima Goel also struck a dovish note, said that, inflation expectations are coming down, inflation rates are coming down, global commodity prices are coming down, and therefore, even the pressure on the rupee is coming down, she pointed out, and therefore the need now is to give growth a chance, allow the credit drought to end. Sum and substance, one member, Patra, clearly hawkish. Governor Rajiv Ranjan and Bhide could be termed as middling, and Verma and Goel clearly dovish. So I would say the hawkish tone clearly surpassed the dovish tone.
All right, Lata, thanks a lot for getting us all of the highlights from inside the MPC meet and also taking us through this divide between, the panel. But with that, we have to get into a short break now. On the other side, we're going to shift focus and tell you all about the world of commodities. Manisha Gupta will join us for an update. Welcome back. You're still tuned into Trading Hour. Little bit of a pickup in the market. We're now seeing around a 50-point cut on the Nifty. So there has been a little bit of a pickup off the lows. It is the mid-cap index, which is still, contributing a lot to the losses. So it's over 330 points over there gone on the mid-cap index. And the banks also seem to have recovered a little bit. So the Nifty Bank Index is now only seeing a cut of 0.2%. So there is a little bit of a recovery playing out there. But let's now talk about the world of commodities and what's going on there. Manisha joins us for an update. Manisha, what are you looking at today?
Pavitra, I'm looking at the metal prices as a sector. While the non-ferrous metals are not doing so well, it is the ferrous metals which still seem to be holding on to their gains there. So when you look at the steel prices, we are holding very close to those 15-week highs. Iron ore prices have actually done well, around $113 a ton. So that's in 6-month highs for this as well. The latest trigger for the metal prices or the ferrous prices to do well has been that China's Evergrande group has resumed work on nearly 631 pre-sold but undelivered, unfinished projects. And that tells the market that the demand for the metals and the construction material could be coming back here. But the cold weather and the holiday season, of course, would continue to weigh on to the demand, is the reason with every uptick we have seen some profit taking come in here as well. But expectations are that the China will deliver further stimulus here. We have seen the November steel output from China decline by 6.5% on a month-on-month basis as well. And the markets also are looking at a boost in economy and infrastructure as a sector. That is what has been discussed in China for their 2022 and 35 plan, which also has been issued by the cabinet already. In the fourth quarter, the China has extended new $162 billion also for the boost in infrastructure. So all of those factors clearly supporting metal prices on the lower sides there. When you look at a month-on-month basis, we have seen good gains come in for steel and iron ore, both these commodities up by nearly 7 to 16% for that. On an year-on-year basis, there still is a negative and a decline onto that one, where we have seen the steel prices decline by 15%, iron ore is down 6% in this year currently.
Okay, well, thanks a lot, Manisha, for that. For the market, actually, it is holding on to these levels of 18,150. So the low that we hit was 18,106, and we've come off a little bit from that. So finding some support at 18,150 at the moment. Let's slip into a quick break. When we return, we'll get market technicals going with Himanshu Gupta of Globe Capital. Stay with us. Welcome back to Trading Hour on CNBC-TV18. As promised, we have Himanshu Gupta, who's the Vice President Research at Globe Capital, who joins in for a quick technical check of the market. Himanshu, good morning, and thanks for being with us. So this 18,100 level, at least for now, it's holding. But do you reckon that given all the volatility we've seen in the recent past, is that a level that can break down very soon? And what's the slightly medium-term target on the index now?
Very good morning to you. Well, I think the short-term technicals are suggesting that we might actually test that 18,000 support zone, or even might slip a little lower than that as far as the intermediate term support is concerned. And I think area close to 17,950, 17,800, this 100-150 points range to me looks like a immediate strong intermediate support zone, which is likely to be tested in this leg of decline itself. Now, the increasing evidence of this volatility or increase in the downside pressure is basically the strongest pocket in this market was Nifty Bank, and when yesterday it broke actually below that 43,000 crucial support mark, that additional pressure is actually being witnessed in Nifty as well. So I think from a short-term perspective, one should be embracing for 17,950, 17,800 supports that are likely to be seen. From a short-term or from an intraday trading perspective, I think a bounce towards 18,175, 18,200 should be used to go short again. Place a stop loss above 18,260, and on the lower side, I think 18,050, 18,000 can be seen in today's session, given the weekly expiry pressure as well. The data has been turning negative, and it has been worsening ever since with each passing hour. On the Nifty Bank, again, 42,650, 42,650, 42,700 is a short zone from an intraday perspective. A stop loss above 42,800 can be placed here. On the lower side, I think 42,200, 42,000 kind of levels are something to watch out on the lower side. So both the indices to me remain a sell on rise.
All right, sell on rise for both of the indices. Any fresh trades that you would look at right now?
A couple of selling ideas in F&O stocks. The first one is a sell on Coal India. The stock is actually breaking down from a long consolidation, and the chart setup is suggesting that a 5 to 7% decline can be seen here in the near term. So Coal India is a short around current levels of 221, place a stop loss above 225. On the downside, targets close to 210, 208 can be seen in the very short term. The second one is a sell call on Indian hotels. Now this was one stock which was actually very strong, but today a breakdown of a very strong support that's below 300, 301 odd levels, which happens to be a neckline on the daily charts. It's a breakdown from a head and shoulder top. I'm afraid in the short term, the stock has a potential to slip towards 280, 275 level also. So one can initiate short in Indian hotels. Lays a stop loss above 306 on the downside from a short term perspective. 290, 285 are the targets that one can expect here.
Thank you very much, Himanshu, for that. Now, 2022 has seen some of the most high-profile mergers and acquisitions dominating the deal space. The year gone by was marked by some much-awaited bailouts and landmark deal closures. It was also the year M&A activity in India defied expectations. My colleague Nisha Poddar gets us a deep dive on all the hot deals of 2022.
The year 2022, as it comes to an end, has clocked in deals worth $118 billion so far, majority of which came in from the mergers and acquisition space, while private equity also participated with $33 billion. Now, in terms of the sector breakup, well, top 5 in M&A came in from first the banks and financial services topping the chart, followed by other sectors like manufacturing, IT, renewable energy, as well as logistics. Now, the private equity investments were highest in the e-commerce space in the year, followed by other sectors like media. We saw a lot of interest, infrastructure, energy, as well as the financial services. Let's also take you through the top 5 deals of the year. HDFC and HDFC Bank's mega merger clearly is the largest, boosting the overall deal value for the year. And the second one is Holcim Cement Assets, Ambuja, as well as ACC. And that was the most hotly contested battle amongst various conglomerates, won finally by the Adani Group. Now, Biocon's acquisition of Viatris's biosimilars business is also path-breaking in the context of an overseas acquisition done by an Indian company. Fourth on our list is the global steel giant ArcelorMittal's acquisition of SR Group's ports as well as power assets, critical to its steel assets, which, remember, marks the full and final completion of the SR Steel's buyout via the IBC process, which, remember, has been a very long-drawn deal. So that comes to an end now. And last is the Yes Bank equity deal by private equity firms Carlyle as well as Advent, which, remember, is an important milestone in Yes Bank's bailout plan. Now for the year ahead. Most deal makers are cautiously optimistic about the deal activity, and consolidation could be a big theme play out as economic pressures weigh on the weaker companies. Now, the startup funding winter is already here and expected to intensify further. With the valuations volatile, well, deal closure could be a challenge, while private equity braces up for some value buying in the next year.
All right, Nisha, thanks a lot for getting us all of that very exciting deal activity from the year gone by. But with that, we have to get into a short break. On the other side, we're going to put the spotlight on malls to understand what is going on with the holiday season and what does this mean for footfall. So a quick demand check is coming up for you on the other side of the short break. Hi guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18. Now, with the holiday season upon us, we aim to look at what this has meant for footfalls as well as occupancy levels across malls. So to get a check on the on-ground demand as well as consumption trends, we're joined by Sameer Pathak, Chief Executive Officer of Malls and Head of Retail at Oberoi Realty, as well as Mukesh Kumar, Managing Director and Chief Executive Officer at Quest Mall, Kolkata. Remember, we're just speaking to two players here, but we're trying to understand what trends in the entire the mall space really looks like. Mr. Pathak, if I can come to you first. First of all, gentlemen, thank you very much for joining us and taking out the time today. Mr. Pathak, if I can come to you first. The last time we spoke, I think your occupancies were already very high at around 96, 95 kind of levels. Can you tell us, has there been any increase even from there? And do you think that there's scope for this to go up further because of the kind of demand that we're seeing?
So we are almost touching the pre-COVID level as far as footfalls are concerned.
Okay.
And the consumption against each of the footfall has grown by almost 34%. So I think we all are very jubilant of these facts and numbers coming in. And we are quite, upbeat about the year which is ahead of us.
Okay, Mr. Mukesh Kumar, who's the Managing Director and Chief Executive Officer at Quest Mall, Kolkata, is also with us. Mr. Kumar, what are your thoughts? Has it come back to pre-COVID levels in terms of footfalls? Has it been better? And what do you see as the big trends in the early part of the new year?
Very good morning to you. Yeah, in fact, if you look at the footfall, it's really improved compared to last year. Technically, if you look at this year, after 2 years, this year, we are seeing a complete, there's no concern, there's no fear. People are taking holiday, people are going out. So what has happened, travel has really increased. People are taking holidays. So the fashion buying really increased. The travel gear buying really increased. It's also adding to the footfall as well in the mall. And technically, if you look at again, the footfall generally picks up only from the second week of December when people have holidays. So I think the trend is very, very good. Overall, there's an increase of, if you look at malls, not just in Calcutta, if you look at the entire country, I have the numbers here with me. If you look at the south, their footfall increased by almost 20% and the sales increased by almost 30% compared to last year in the month of December. In the west is following the number 2, they have increased 15% in terms of footfall and 25% in terms of sales. North is not that as good as what generally they do. And same in the eastern part of the country also. But we have increased by 10%, eastern increased by 10% in terms of footfall and 12% in terms of sales. So overall, I think it's a good growth. And mind you, this is not just it's not a price growth, it's a volume growth. There is a more demand today. The people are buying more. Price setting already happened last year. It's all about the volume growth. So I think overall, it's a very good situation. Wedding season is almost kind of over for this year. Next year is going to pick up from the month of Jan onwards. So we also see a better demand in the month of Jan as well, February, the next quarter.
So, Mr. Kumar, what you are telling us that in South as well as West, the sales have been higher than the footfalls compared to pre-COVID levels, which basically means every customer who's walking in is spending far more than what they did 3 years ago,
Absolutely right?
Okay.
Absolutely right. The bucket size really got up almost 15%.
Got it.
So if somebody is spending 100 rupees, they're spending 115 rupees.
Got it.
So that's a good sign for the industry as well.
Mr. Pathak, you told us that footfalls at your mall are up 34% versus pre-COVID level. What would the comparable revenue growth be, and where is it that you are seeing maximum spend? What are the hot selling items now? Is it more electronics? Is it, toys? Tell us what the growth areas are, and how are discounts this December?
So I'll start with the categories which are performing well, and I think almost all categories are showing the trend upwards. The top 5 categories is athleisure, luxury, which is watches, and apparels. They are the one who are seeing the upward trend. Apart from that, in terms of the consumption, we are seeing, compared to pre-COVID level of 2019, we are seeing a consumption increase of overall 10%. As far as trading density, which is the realization per square foot of sales is concerned, that is touching almost 18%. So I think overall there has been a good growth and across all categories.
Okay.
Cinema is something I want to mention is now picking up with some very fantastic releases which we have seen in current week, and then the one which are upcoming during Christmas, and followed by Republic Day, which is next year, 3rd week.
All right, got that. Mr. Kumar, you were just mentioning how footfalls are higher, but more than that, consumption has also seen a big pickup across your malls. This should then mean that you're able to get higher rentals as well, right, from retailers. Can you tell us if there has been a pickup there? And also, how often does the renewal of contract happen? I'm talking about the rent agreements.
renters, they don't increase every 2 months to 3 months. Having a long-term contract, most of the contracts are long-term contract. The correction already happened last 2 years' time. After COVID, I think from last year, prices started going up. The rental, I think, reached that level. The new lease is happening at a much higher rate, I think almost 20% higher than the current rate. In terms of it, I think if you look at total growth in
Kumar,
terms of
we can't hear you very well, so we're just going to try and fix that audio in a bit. It's nothing from your end. We're just trying to sort of resolve that audio. But Mr. Pathak, since everything is opened up now, I wanted to check with you on what the future expansion plans are on the mall front. Since there's just one mall currently under the Oberoi umbrella, are there any plans, especially in pockets like Bombay, maybe even in the north, to open new malls? If yes, not this year, maybe over the next 2 to 3 years, what would the plan be of expansion?
So 23 is where we are going to add one more asset, which is 1 million square feet, which will be towards the northern part of Mumbai. Apart from that, we are going to add another 2 million in next 5 years, again in Mumbai, which will be Thane, 1.5 million square feet, and Worli, which will be close to about 6 lakh square feet. So that's what the expansion currently, which is absolutely clear, and we are working towards that.
Mr. Pathak, Mr. Kumar, thank you very much for joining in. We're out of time, but have a very Merry Christmas and a very Happy New Year as well from everyone from CNBC-TV18. We'll get into a short break. On the other side, we'll discuss market fundamentals. Pankaj Murarka of Renaissance Investment Managers joins in next.
Welcome back. As promised, we have Pankaj Murarka joining in now. He's the founder of Renaissance Investment and he's going to help us wade through this market. It's the fag end of the year, Pankaj. So greetings of the season to you. What a year it's been. I mean, a rollicking ride both ways. And a couple of trends have stood out, right? Whether it is going short on IT, going long on banks, going long on defense names. What do you think would be the top 2 or 3 trends of 2023?
Well, first of all, greetings to you and all your team and all your viewers. I think, Sonia, coming back to the point, I think just to put things in perspective, last 2.5 years post-COVID has been more about macro tailwinds, where we've had significant macro tailwinds globally and locally in terms of low interest rates, fiscal expansion, central bank pumping in money, and so on and so forth. This year has been a year of transition where we've had significant rate hikes. And I think next year is going to be a year about macro headwinds because the cumulative rate hikes that we've had this year will have an impact on growth next year. And most of the governments across the world are on a path of fiscal consolidation. So those low-hanging fruits are not there. If the world is going to be an environment where we face macro headwinds, then I think what really works well in this kind of environment is companies which have very strong or robust business models. And it's going to be all about bottom-up stock picking. So in that context, I think it's not about sectors or theme, but it's more about specific companies and bottom-up stock picking, which is what the next year is going to be.
Pankaj, morning. So what are some of the latest ideas from Renaissance Investment Managers?
Well, one, we think pharma as a sector can really do well next year because it's been a sector which has been underperforming for the last 2 years. And we think we've reached a stage where the entire sector's profit pool will probably trough out this year because the sector is having negative earnings growth for the last 2 years. We think all of those headwinds are behind and probably next year onward, the sector will start delivering healthy earnings growth. So that's one sector we really like in that sense. Also, at some level, we think that this year started with a lot of euphoria and expectations out of some of those internet companies which got IPO'd early part of the year. We've seen significant valuation correction, price correction in that space. So we like some specific names in that space as well because we think underlying growth in internet businesses continues to remain very strong, not only next year, but even from a medium term to longer term perspective, and valuations there have moderated significantly.
Okay, hi Pankaj, morning. So you were saying that you like these internet companies. I know Paytm is on your list. So take us through the rationale there, and anything else you like from this space, the likes of Nykaa, Zomato, anything else from the new age companies that looks exciting?
Well, one, at a broader level, we are excited about the whole internet ecosystem because our belief is that India's overall internet economy, which is just about $100 billion, can grow 2x the underlying, economic growth or GDP growth, and probably it can become $500-600 billion over the next 7-8 years. So obviously, we like everything. We like the sector as a whole, and we're looking at all of these businesses. Coming back to Paytm, yes, we have ownership there, meaning the idea behind Paytm is very simple. I think payments, as the economy grows, payments and digital payments will keep growing. And now they've started making money out of their core business, which is the digital payments business. And more importantly, they are leveraging their customer base to cross-sell other products to the customer base. So I think our view is probably they should turn cash flow positive probably by the end of this year. And given the significant size and scale that Paytm and many of those internet businesses have built, once they get profitable over a period of time, they're going to generate significant amount of cash flows. So we think over a period of next 2 to 3 years, they can churn out significant amount of free cash. And that is actually, to my mind, not priced into the current pessimism that's prevailing in the stock.
Okay, by the way, the market is now at the low point of trade. It's given up on that 18,100 mark as well, down over 105 points. So don't lose sight of what's happening there. I wanted to just quickly point out a couple of brokerage views on cement that stand out today. Kotak put out a note on cement where they say they're very bullish on the cement space. They talk about how prices continue to see a nominal uptrend in December. There are sharp price hikes that have been taken in the east part of the market. There's about a 1.5% quarter-on-quarter hike, and not just prices being hiked, there's also softness in petcoke and thermal coal prices, which should ease cost pressures for them. There's another note that DAM Capital has put out on Ultratech Cement, and they have a target price of 8,200, which is quite a big upside to the current market price. They say the entire cement industry is entering into an upcycle, and this is led by pre-election demand and uptick in real estate, manufacturing, as well as capex, and they expect a compounded volume growth of over 10% in the next couple of years. Pankaj, very quick thoughts on the cement sector. Would you buy now? And if yes, what would your top picks be?
Well, I think the point remains that demand is going to be seasonally strong over the next year because, one, we are seeing strong uptake in real estate and core sectors. And apart from that, the pre-election public expenditure should drive that. Our preferred bet in the sector would be, we generally tend to go with sector leaders. So preferred bets for us would be Ultratech in that sense.
Pankaj, out of time, but thank you very much for joining in. Need to slip into a very short break. On the other side, we'll get you more on the market.
Welcome back. As we wind down on this year, here's our special series. 2022 was really the year when the Nifty Bank outperformed the Nifty as three large names, SBI, ICICI Bank, as well as HDFC Bank, saw a massive re-rating in their valuations. So Abhishek is here to chart up the ups and downs of the big three names in banking in the year gone by.
Bank Nifty has underperformed Nifty. However, in 2022, Bank Nifty has outperformed Nifty in a big way. So far, Bank Nifty has risen by more than 21% in 2022 compared to around 7% gains that you are seeing for Nifty. ICICI Bank has given a return of 25%, SBI about 32%, while HDFC Bank has given a return of 8.5%. Talking about HDFC Bank, first time in 3 years, in a calendar year, HDFC Bank has given a return that is higher than that of Nifty. Well, large banks have seen massive re-rating in their valuations, the likes of ICICI Bank, SBI, etc. HDFC Bank has its own woes with respect to high valuations getting corrected, which began with Mr. Puri retiring from the bank to now merger of HDFC Limited with the bank, which has not seen much enthusiasm from investors. Let's take a look as to what were the ups and downs of the big three banks in the banking sector in 2022 and what lies for them going ahead. So loan growth. Talking about loan growth, HDFC Bank, ICICI Bank and SBI have all recorded record growth rate in all quarters of 2022. Corporates have started coming back to banks as money market rates have started to heat up, even as retail and MSME portfolio have been the big drivers of incremental loan growth in the banking sector. Strong loan growth momentum has helped the banks with respect to improvement in their net interest margins as well. All the three big banks have seen their net interest margin being the highest in last 5 quarters. The key to re-rating has also been the reduction in stress assets. Talking about stress asset, restructured book, one of the most painful part of the stress assets in last 2 years has been the huge amount of restructured loans. These were loans which were impacted from the COVID wave with respect to repayments. Now, restructured book for SDFC Bank, ICICI Bank and SBI have reduced anywhere between 30 basis point to 85 basis point in the last 5 quarters. Gross NPA. The banking sector has been battling asset quality woes even before COVID impact. COVID only added fuel to the fire and led to higher stress in the system. 2022, however, has been a different story. Gross NPA ratio has declined by 12 basis points on a low base for SDFC Bank in last 5 quarters, by about 163 basis points for ICICI Bank and 138 basis points for SBI, all over the last 5 quarters, improving profitability. Thanks to strong loan growth translating into improvement in net interest margin, along with improvement in credit costs, banks have seen robust momentum in their earnings profile. Profit growth of SDFC Bank, ICICI Bank and SBI have been robust over the last few quarters and it continues to improve. Now, return on asset ratio has also improved for the banks. This can be said as one of the key reasons with respect to re-rating in the valuation multiple of these large banks. Now, ROA has improved by 14 basis points for SDFC Bank, 27 basis points for ICICI Bank and about 43 basis points for SBI over the last 5 quarters. This can be seen in valuation multiple of the banks as well, which has seen improvement in 2022.
All right, that's a great summary of the banking sector and the outperformance that it has seen in the year gone by. With that, it's a wrap on Trading Hours. Stay tuned. Halftime report is up next.